The investing technique that Warren Buffett employs can be boiled down to 7 simple guidelines that everyone, including you, may follow. Therefore, let's begin with his first guideline, which is that you should never keep a stock for more than 10 minutes unless you are prepared to retain it for 10 years. As we conclude this enlightening video, we are left with a powerful set of guidelines inspired by Warren Buffett's decades of investment expertise. How can these 7 rules help us make more informed and effective investment decisions in the current year? What steps can we take to align our strategies with Buffett's time-tested principles? How can we adapt these rules to our own financial goals and risk tolerance? The teachings of Warren Buffett offer a beacon of light in uncertain times, reminding us of the importance of discipline, research, and a long-term perspective in the world of investments. Stay tuned to the Financial Fortune channel for more expert insights and analyses on wealth building and smart investment strategies. Remember, learning from the masters can pave the way for financial success. Until next time, may your investment journey be guided by the principles of Warren Buffett and lead to prosperous outcomes.
I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote and never pay it. You don't need to pay attention to them.
Holdings for an extensive amount of time. People should not take my advice and invest in the stock market today, tomorrow, the following week, or the following month. If you want to keep the shares for a very long time, it is in your best interest to purchase them. You shouldn't hold a firm for 10 minutes unless you're ready to hold it for 10 years, according to one of Warren Buffett's most famous quotes. This prevents you from falling into the attitude of gambling and forces you to concentrate on the real business that you are buying and the future of that firm.
You've got to be prepared to, when you buy a stock, to have it go down 50% or more and be comfortable with it as long as you're comfortable with the holding. And I pointed out, I think a year, maybe 2 years ago in the annual report, just the one before this most recent one, I pointed out that there have been 3 times in Berkshire's history when the price of Berkshire stock went down 50%. 3 different times. Now, if you owed it on borrowed money, you could have been cleaned out. There wasn't anything wrong with Berkshire when those 3 times occurred. But if you're going to look at the price of the stock and think that you have to act because it's doing this or that, or somebody else tells you, well, how can you stay with that when something else is going up or anything? You've got to be in the right psychological position. And frankly, some people are not really careful. Some people are more subject to fear than others.
Don't get caught up in the short-term gambling mentality. Instead, think on the long term.
The real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. If you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
Avoid going into the red. If you buy goods for a price that is far below what they are worth and you buy a bunch of them, you practically won't lose any money. The key is to make sure that the 4 losers don't penalize you for your purchase. According to Warren Buffett, if you find yourself in a hole in the stock market, the most essential thing you can do is to quit digging. When you acquire companies for less than they are worth, the likelihood of you suffering a loss is significantly decreased. Buffett was able to avoid financial loss as a result of his investment in Taiwan Semiconductor because he purchased the stock at a cheap value and then sold it nearly instantly throughout Q4 and then Q1 after realizing that he had, quite simply, made a mistake in his assessment of the company.
The only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference after as you get further out. But And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question of how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you?
Value that is derived from oneself. You will need to spend money today if you want to be able to obtain more money in the future. As time goes on, the discount rate doesn't make as much of a difference, but the question that remains is how much cash you will get. If you buy a farm, an apartment building, or any other financial asset that is oil in the ground, you are investing money now in order to receive further money in the future. The questions that need to be answered are as follows. When are you going to get it? How much are you going to get? And how certain are you? Buffett purchased Apple in the first quarter of 2016 at a price-to-earnings ratio of 12, and since then, the company's annual free cash flow has increased from $53 billion to $111 billion. Stick to businesses that you understand, and if you can't answer the issue of whether the firm can deliver enough cash to you, the owner, quickly enough to make it logical to put down that capital now, stay away from it.
But the real question is, Berkshire's selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock. You can gamble in the stock if you want to, or your neighbors can buy it. But if you don't answer that question, and I can't answer that for internet companies, for example. There are a lot of companies, there are all kinds of companies I can't answer it for, but I just stay away from those.
This is the second important lesson that Buffett has learned, and it is to stick to businesses that you understand.
I have an old-fashioned belief that I should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know, in general, what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business. Defining your circle of competence is the most important aspect of investing. It's not how important, how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, the stocks are going up and everything, they start fooling around someplace else, eventually I'll get creamed, and I should.
Acquire certain companies. I have this archaic notion that the only way for me to generate money is to do it with endeavors that I fully comprehend. Even while I have a basic idea of what the economics of the company will be like in 10 years from now, I am unable to predict exactly what the figures will look like. When you're just getting started in the stock market, you probably utilize a stock screener to identify some stocks that appear to be selling at low prices. However, you usually don't conduct enough research to fully comprehend the company whose shares you're purchasing. You will be completely at a loss for what to do when the price of the stock begins to fluctuate. When it comes to investing, it's important to stick to your area of expertise. Be aware of the things that you do and do not know. If you become enthusiastic about something that you don't understand, but your neighbors are talking about stocks going up, you're going to get beaten up. Never invest in cigar butts.
I've been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, we'll say in 1949 or 50. It made a big impression on me. So I went around looking for what I call use cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. But in those days, I was buying cheap stocks. And Berkshire was selling below its working capital per share. You got the plants for nothing, you got the machinery for nothing, you got the inventory and receivables at a discount. It was cheap. So I bought it. And 20 years later, I was still running a lousy business, and that money did not compound.
I was trained to make purchases based on a quantitative basis, to seek around for items that are inexpensive, and I looked around for what I like to call cigar bundle of stocks. Although it is possible to make money doing it, you cannot make significant money doing it. This is a mistake. Buffett was taught by Charlie Munger that purchasing a large and diversified basket of low-priced firms was not the most effective way to go about things. Instead, Buffett should focus on purchasing high-quality businesses and maintaining ownership of them for an extended length of time. Buffett acquired Apple at a reasonable price, knowing both its quality and its potential in the runway, and the investment turned out to be quite profitable for him. When others are afraid, you should show greed.
People behave very peculiarly in terms of the reactions because they're human beings, and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful, and they'll continue to do so. And you will see things you won't believe in your lifetime, and securities markets. And the country will do very well over time, but you will see these huge waves. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich. And you won't have to be very bright. I mean, I'm sure you are, but it doesn't take brains. It takes temperament. It takes the ability to sit there and look at something. When I started out in 1950, I would go through and find things at 2 times earnings, and they were perfectly decent businesses, and people wanted jobs at those companies, and everybody knew they were going to be around, and they wouldn't buy them at 2 times earnings, and that's when interest rates were 2.5%. I started selling securities when I was 21, and a Kansas City life insurance company happened to be a fairly prominent company in Omaha, and the policies they sold you, if you were buying life insurance from them, had a built-in assumption of 2% interest. The stock of Kansas City Life was selling at less than 3 times earnings. You were getting 35% if you bought the stock. No question about the soundness of the company. I went to the local agent. I figured, hell, I ought to be able to sell him a few shares of stock. I mean, the guy ought to understand it. He's got his whole life invested in this company. I went to the local agent who'd been with him for 20 years, and his name was Moose. And I said, Mr. Moose, I said, you're selling these policies with 2%. You may even have a few members of your own family, and you can buy into this company whose paycheck you depend on every month, and whose future your beneficiaries of these life policies depend on, and who you're selling them, a 2% investment on, and you can get 35% on your money. He said, stocks aren't any good, and I couldn't sell the, I was a lousy salesman. I mean, well, you have to start with that, but it just blew me away. It blew me away. I thought. Sometimes I used to wonder if I was nuts, but those things, the same thing happened. I mean, in 1964, the Dow closed at 864. At the end of 1981, 17 years later, it closed at 865. It moved 1 point in 17 years. Now, that's not a big move. And that, you can't believe how discouraged people were during that period. But, people were living better. So things can go on a long time that don't make sense, but they do come to an end. I mean, the internet thing. I mean, you had these companies selling for many billions of dollars that had practically no prospects of making any money. That's a bubble. But Herb Stein one time said, anything that can't go on forever will end. Now that seems pretty. But think about that, and particularly think about it next time you're inclined to do something just because the stock's gone up a whole lot, and your neighbors made money or something. you've got to be, you just have to sit and think objectively and think about, would I buy this whole business? If it's an internet company that's got 100 million shares out and selling at 100, that's $10 billion. Is it worth $10 billion? If it's worth $10 billion, it's got to be able to give you, 700 or 800 million next year. And if it doesn't give you 700 or 800 million next year, it has to give you maybe 10% more than that the year after and continue to. There aren't a lot of businesses that can do that. And people just go crazy. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in 1970 put 100 and some % of their new money in stock because they were wild about stocks. Then they got a lot cheaper and they put a record low in, 9% of their net new money in 1978 when stocks were way cheaper. Investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say, this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity, just huge opportunity. I mean, I've lived through roughly half, in an investing sense, about half that period. And I've had that long period of stagnation from 48, from 65 to 82, 17 years.
Individuals exhibit odd behaviors when others are greedy. For example, individuals tend to become greedy when others get greedy, and people tend to become afraid when others become fearful. In your lifetime, you will witness things in the securities markets that you just won't believe. Investors have extremely human behaviors, and they tend to operate in groups when making decisions. They experience feelings of greed when they witness a lot of money being created, and they experience feelings of dread when they see no money being made at all. Buffett's investment technique is buying high-quality companies when there is a widespread market panic and acting greedily when everyone else is worrying about their investments. It requires temperament, as well as the capacity to just sit there and observe things, but it does not require intelligence.
It doesn't take brains, it takes temperament. It takes the ability to sit there and look at something. When I started out in 1950, I would go through and find things at 2 times earnings, and they were perfectly decent businesses, and people wanted jobs at those companies, and everybody knew they were going to be around, and they wouldn't buy them at 2 times earnings, and that's when interest rates were 2.5%.
Make the most of your occasions. It is important to make the most of one's life's major opportunities. Because you are not going to have 500 fantastic opportunities, you need to be watchful and mentally ready yourself to act when those possibilities do show themselves.
Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come, because you're not going to get 500 great opportunities.
Consider writing out some of the things you want to do in terms of investing during the following 30 days. So get on with it. The errors that we failed to do are by far the most significant ones that we've made, and the ones that we neglected to do are the ones that have caused us the greatest pain.
The biggest mistakes we've made by far, I've made, not we've made, biggest mistakes I've made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. They don't show up anyplace. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. And I don't worry about that if it's Microsoft because I don't know it. Because Microsoft isn't in my circle of competence. And so I don't have any reason to think I'm entitled to make money out of Microsoft or out of cocoa beans or whatever. But I did know enough to understand Fannie Mae, and I blew it. And that never shows up under conventional accounting. But I know the cost of it. I know. I passed it up. And those are the big, big mistakes.
As As we conclude this enlightening video, we are left with a powerful set of guidelines inspired by Warren Buffett's decades of investment expertise. How can these 7 rules help us make more informed and effective investment decisions in the current year? What steps can we take to align our strategies with Buffett's time-tested principles? How can we adapt these rules to our own financial goals and risk tolerance? The teachings of Warren Buffett offer a beacon of light in uncertain times, reminding us of the importance of discipline, research, and a long-term perspective in the world of investments. Stay tuned to the Financial Fortune channel for more expert insights and analyses on wealth building and smart investment strategies. Remember, learning from the masters can pave the way for financial success. Until next time, may your investment journey be guided by the principles of Warren Buffett and lead to prosperous outcomes.